Most people think bonds are boring, safe, predictable, and reserved for conservative investors. The reality is very different. Bonds are the largest financial market in the world, larger than equities, larger than real estate, and the biggest players in this market are not retail investors. They are pension funds, insurance companies, asset managers, and sovereign wealth funds managing trillions of dollars. In this video, I am going to explain what a bond actually is, how it works, and why institutional investors rely on them more than any other asset class. A bond is a loan. When a government or a company needs to raise money, instead of going to a bank, they can go directly to the capital markets. They issue a bond. They borrow money from investors, promise to pay interest periodically, and return the full amount borrowed at the end of the agreed term. The entity that issues the bond is called the issuer. The investor who buys the bond is called the bondholder. The periodic interest payments are called coupons. The date when the principal is returned is called the maturity date, and the amount borrowed, which is returned at maturity, is called the face value or par value. Let's make this concrete with a simple example. Imagine a government needs to raise $1 billion to finance infrastructure projects. It issues bonds with a face value of $1,000 each, a coupon of 3% per year, and a maturity of 10 years. An investor who buys one of these bonds will receive $30 every year for 10 years and $1,000 back at maturity. That is the basic mechanics of a bond. Now, the coupon can be fixed or floating. Most bonds pay a fixed coupon, the same amount every period, regardless of what happens in financial markets. This predictability is one of the reasons bonds are called fixed-income instruments, but not all bonds work this way. Floating-rate bonds, also known as floaters, have a coupon that changes periodically based on a reference interest rate. In the United States, the most common reference rate is SOFR. In Europe, it is Euribor. A floater might pay Euribor plus 1% every quarter. As market rates move up or down, the coupon adjusts accordingly. Institutional investors use both types: fixed-rate bonds for long-term liability matching, floating-rate bonds to manage interest rate risk in portfolios where duration needs to be kept low. So why do institutional investors rely on bonds more than any other asset class? The first reason is predictability. Bonds provide known, scheduled cash flows. A pension fund knows it will need to pay retirement benefits in 2030, 2035, and 2040. A life insurance company knows when policyholders will claim their savings products. Bonds allow these institutions to match their future obligations with predictable income streams. This is something equities simply cannot offer. The second reason is seniority. In the event of a bankruptcy, bondholders are paid before shareholders. This legal seniority makes bonds significantly safer than equities for institutions that manage other people's money and cannot afford large, unexpected losses. The third reason is scale. The global bond market is estimated at over $100 trillion. This gives institutional investors the ability to deploy billions of dollars without moving the market significantly. An insurance company managing 50 billion euros in assets needs markets large enough to absorb its transactions. The bond market provides that scale. The fourth reason is regulatory alignment. Most regulatory frameworks, Solvency II for European insurers, risk-based capital for U.S. insurers, Basel for banks, favor bonds over equities in terms of capital requirements. Holding bonds typically requires less regulatory capital than holding equities with the same market value. For institutions that must optimize the return on their regulatory capital, this matters enormously. These four reasons, predictability, seniority, scale, and regulatory alignment. Explain why bonds form the core of virtually every institutional portfolio in the world. If you found this useful, subscribe for weekly videos on fixed income, institutional investing, and portfolio management. And if you want to go deeper with a structured learning path, check the link in the description.